Hello and welcome. My name's Kevin Igo, Managing Director of PFP, and I'm delighted to welcome so many of you on our call today, on our webinar about top 10 tax tips. Now, I'm delighted this morning we've been joined by three individuals from Claritas Tax. There's Matt, Sam and Cez. So if I could perhaps ask you all to firstly introduce yourselves and a little bit about your background, please. So Matt, do you want to kick off?
Yeah, thanks, Kevin. Good afternoon, everybody. So I'll just move on to the next slide first of all. Just a very brief intro in terms of who we are and what we do. So we're currently a team of 40 tax professionals based in Manchester, Birmingham, London. And put simply, we cover every aspect of tax. So that's pretty much who we are and what we do. Personally, I'm a transaction specialist and I lead the Manchester office. Sam?
I specialise in private clients. I lead the private client practice across all our offices, and I've over 20 years experience in dealing with wealthy individuals.
And Seth?
Hello everybody, I specialise in M&A. I head the M&A tax service line for Claritas Tax. Our background is a Big Four background. I have a legal background as well as a tax background, so it's slightly different in that sense. And I have about, I think, like 20 years plus service. I forget now, it's been that long.
Thanks, Seth.
Okay. Thanks. So before we go on, can I just let everybody know, if you want to raise questions, please do. Now, by the nature of today's talk, it's covering quite a lot of areas. So if it works out that we're better off asking questions at the end, then that's what we'll do. If we feel it's convenient throughout, as we normally do, then we will. What I would say is that we will be sending around a copy of the slides afterwards. So you'll all get those. So, Matt, over to you.
Fantastic. Okay. So, and just so that you're not looking at a blank screen in terms of who we are. I won't dwell on our pictures too long, but just so you know what the speakers look like today as well. And then just in terms of the agenda, so we thought long and hard about what we wanted to present today, and I think we felt that what we wanted to share with you all is pretty much what we see on probably a weekly basis across the business, just in terms of where we think risks can be mitigated in certain areas or efficiencies gained in carrying out projects, because we're aware that we're speaking to an experienced audience who will be involved in a lot of these different areas. So we just wanted to share some of our experience with you. So first and foremost, Sam, do you want to go first on this?
Yes, I will. Thanks, Matt. As Matt said, we just wanted to pick up some of the points that we come across and some of the things that you're probably coming across in your day-to-day life. And the first thing we wanted to talk about was the Enterprise Investment Scheme, and obviously its baby sister, the Seed Enterprise Investment Scheme, which is a very similar scheme but on a smaller basis. Just in case you're not aware of what the Enterprise Investment Scheme is, I'm sure you all are, but it's basically a scheme where the revenue acts as a matchmaker for new untested companies that need investment, and it matches them essentially with investors that want to put money in. Quite simply, these companies are risky, but obviously produce opportunity for greater reward. So by offering a tax incentive to people, HMRC is attracting investors to invest in these smaller companies. Now, Matt's going to talk about the company aspects. I wanted to talk about it from an individual investor point of view, and some of the things that are good about it, and some of the things that, just little tips that we thought we'd pass on to you. So the EIS scheme offers 30% tax relief. That's a fixed amount. So it doesn't matter what your marginal tax rate is, the relief you'll get is 30% on your investment. And you can invest up to £1 million per tax year. Now, actually, you can invest up to £2 million, provided at least £1 million of that is in knowledge-intensive companies, which are, a whole load more qualifying criteria you need to participate in. But also the EIS isn't subject to the cap on income tax reliefs that other things like losses are subject to. The SEIS is a smaller scheme, can only invest up to 100,000 in that, but you do get 50% relief. So just with those reliefs, although you are risking all of your money in this company, by offering this 30% or 50% tax relief, effectively you're only risking 50 or 70% of your money. The other advantages are that provided that you hold those shares in your EIS companies for 3 years, any gain on selling those shares, it's completely exempt from CGT. You do have to hold it for 3 years, and it is also worth mentioning at this point that not every EIS company is going to make a gain, but if you are, you have managed to invest in the right company, you can potentially realise massive amounts of money and pay no CGT on it. You can also get CGT deferral. For those of you who are as old as I am, this is back to the old reinvestment relief that we used to have, where you reinvested in unquoted shares. And this is the same idea, that if you've got a gain, the amount you reinvest into EIS companies, you can defer the gain that you've generated on other assets, can be any other assets, provided you're investing in the EIS scheme. As a bonus under SEIS, you can actually get a capital gain reduction. Under EIS, basically the gain you've realised is frozen and deferred. Under SEIS, up to 50% of a gain can actually be written off entirely. So what are the tips that we wanted to talk about? Some of them are just little things, just things to bear in mind. The first point is, in order to get this free of CGT disposal on an EIS company, you need to have claimed the relief. That might sound silly, but you do get cases where people don't have significant levels of income, but you do need to claim the relief. Even if you can't claim all of it, so long as you claim £1 of it, you've claimed the relief, then you can get the CGT free sale. You can also claim the CGT deferral relief, so, you know, deferring that gain to the future when you sell those EIS shares, even if you don't qualify for the income tax relief. There are various conditions on qualifying, one of which is that you need to own less than 30% of the company. So even if you own more than 30%, while you can't claim all of the reliefs, you can still claim that CGT deferral if that's important to your clients. And finally, if the company does go under, you can have an allowable loss, but you do need to deduct the tax relief you've already had. If you've invested 100,000 and had 30% relief, the loss available to you is only going to be 70,000. However, because it's an EIS company and we've subscribed for shares in an unquoted company, we can potentially look at claiming that loss against income for the current or previous tax year, rather than just using it against current and future capital gains, which can potentially be more worthwhile.
That's great, thanks, Sam. And just before I move on to the corporate aspects, it's quite timely in some ways. Sam's first bullet on the what's the tip point around claiming your EIS relief. A stark reminder is a letter we've just had from HMRC this morning on that, refusing to accept the CGT relief for a client of ours at a substantial sum as well, because his advisor many years ago forgot to tick the box and claim the original income tax relief. So unfortunately, and there's case law now to back that up, which backs up HMRC's position. So it really is important to claim that relief at the outset. So just on to the, I won't take as long, because by and large, EIS is very much about the investor reliefs, but as I act on the corporate side, and we do act for an awful lot of startup and scale-up companies who are looking for funding, EIS is an absolutely fantastic way to raise that funding. And I guess onto the why is it great then, because Sam's outlined all the sort of the investee criteria. In terms of liquidity, it really is a good way to access growth capital. EIS has been around an awfully long time now. It's government backed and approved, and an industry has been built around it. So we now have EIS funds all over the UK who have had multiple investments and exits from such businesses, some of which go on to be unicorns. So we've seen a few of those recently as well, for relatively modest initial investments. But also within our private client database, and I'm sure many of yours as well, a lot of investors, particularly ones who have exited businesses and are sophisticated and bring with them an awful lot of experience of running businesses, bring not only their money via EIS, but also their experience onto the boards of some of these companies. So that's more my second point there, around that access to sophisticated network of investors. And 20 billion, that's an eye-watering figure raised by companies, from since 1992. That's a serious amount of money, and I suspect that 20 billion that's been raised in terms of the value it's generated must be at least 10 times that, I would have thought. But on to the tips. What we get an awful lot is quite last minute requests to do EIS advance assurance. So an advance assurance, for those who don't know, is essentially a company writing to HMRC, submitting an awful lot of information around business forecasts and things like that, requesting the revenue's assurance that they will qualify for EIS. But it is quite chicken and egg, because if you do that, you actually have to state who the shares that will be issued and who will be subscribing for the shares and so on and so forth. So businesses aren't always in the position to be able to give that level of detail. So whilst advance assurances are always great if you can do them and you've got the luxury of time and you do know who the investors are going to be, the second option, and probably one that we see more of nowadays, is simply the advisor doing a comfort or some form of report, which essentially runs through the same information request and criteria as the advance assurance process, but instead is just essentially a sign off from an advisor like us that says, this business does qualify for EIS. So then the company can take that out to the market, approach investors with a credible sign off and raise their EIS investment that way. That doesn't then prevent them going on to submit the necessary EIS forms after the fact. So an advance assurance isn't a statutory requirement, and you do need to have flex in the process, I guess is the point there. And the final point, which I think is a real surprise, we have an EIS specialist team who are in communication with HMRC quite a lot and in a working group with them. And I was flabbergasted at that low success rate in terms of EIS advance assurances going in. It is quite a prescriptive, for those who haven't done it, a prescriptive submission process, and kind of on the face of it looks difficult to get it wrong. But if the information isn't in good order and sufficient, it will get rejected, and hence that quite low success rate in terms of advance assurance applications. So that was everything from me on the corporate aspects. Over to you, Seth, for EMI.
Thank you, Matt. So I will talk about EMI share scheme. So just by way of quick summary, so an EMI share scheme is a tax advantage share option employee incentive scheme. It's aimed at predominantly entrepreneurial companies that meet certain stringent conditions. So it's designed to assist such companies in recruiting and retaining high quality individuals, and that's a key part. It kind of says what it does on the tin, and it does, and it's well used in that sense, and it is a very powerful tool to keep high caliber employees. And it offers the key thing is it offers opportunities for equity participation by employees in recognition of the fact that smaller companies may not be able to match salary levels paid elsewhere. And you can tag on things like performance-related targets. There could be exit-only events that trigger the exercise event. So it's very flexible. It's really well used, and it's a great tool to keep those people that you want, the future stars of the business. So what's great about the scheme is, as long as you hold the options, as option holder has held options for 2 years, and disposer can qualify for business asset disposal relief, i.e. formerly entrepreneurs relief, and you can qualify at the capital gain can qualify at 10% on the first £1 million of gains. So that's a total relaxation, other than this 2-year rule, from the other BADR conditions, which I know Sam will cover slightly later on. So that's a key incentive. The company on exercise benefits from which can be a material number, which is a corporation tax deduction available on exercise. So that would be the market value of the shares and exercise less the amount paid by the individuals, and that can, especially in the transactional pre-sale process, that number can be quite significant and kind of a material difference on the sale proceeds, and obviously on the individual. One of the key benefits of the EMI share schemes is now it's only one of few occasions where valuation of the business can be agreed with HMRC in advance. It's been many years since they took away the post-transaction valuation checks that they used to allow taxpayers to go ahead and apply for valuation, but that's now gone away, and it's all about it's basically tax advantage share schemes where they allow a valuation to be agreed in advance of putting the scheme in place, which is very powerful. And it can be very powerful when you've got a sale in situ, where the tax DD team of the buyer will look all over the company's records, and if you've got a valuation that's been agreed with HMRC, it takes away a lot of the headache in terms of the valuation and any related tax implications. And I've already talked about the key incentives where kind of attracts key people, and where cash is tight, it's a good way to lock in and incentivize people. So what's the tip? I suppose this is of this slide, the key thing for me is what's the tip, because I've got a couple of live examples where people, it's a great idea, it's a great concept, and it works when it's done correctly, but it can go horribly wrong when the implementation is done badly. And unfortunately, I've seen quite a few of these in my role for the last 2-3 months. I think the point is that people get sold with the idea, the management team love the idea, the main shareholder sell the idea, but I don't know what it is, but people just seem to lose interest during implementation of the scheme, and simple errors will completely gazump the scheme in the sense that it becomes unqualifying, and simple mistakes like the exercise price is incorrect, is not in accordance with what's been agreed with HMRC. The excess price is set lower than a nominal value, which is not allowed for company law purposes. There's no change to the articles of association, and there's been change in the company conditions, there's been change in the option holder's working conditions. So all these events can be disqualifying events, which means that the idea of having these options and the potential gain at 10% or even possibly 20% if the gains are greater than £1 million are essentially lost. And I've had the unfortunate occasion recently where I've had to told the MD and told the option holders, actually you're not going to be paying tax at 10%, you'll be paying tax at 45%, 47% or 62%, depending if there's a PAYE event, and that's not a great message to tell someone who's driven the business forward over that period of time. So the key message is get it right and just don't lose interest during implementation of the scheme. That's it for me, Matt.
It says if we just have a couple of questions here. One from Chris: is an employment contract required for a director to qualify for EMI?
Directors, as long as they are employees, Matt's helped me out here, but I think as long as directors are considered to be employees of the business anyway for EMI. Yes.
Yeah, I don't think I think at best a service level agreement is fine, but I don't think an employment contract is necessary for a director.
Yeah.
Okay, thank you. And okay, we've had a couple of queries on the corporation tax deduction. Can you please clarify how CT tax deduction is available on an exercise if options are granted at market value?
So the rules are that the market value of the shares on exercise, so there'll be some valuation required there. And usually what we tend to see in most occasions are these are exit only events. So you'll have a third party buyer who's got the market value of the shares is agreed at that point, I suppose, with the buyer. So you have the market value of shares on exercise less the amount paid by the individual, i.e. the exercise price. So the difference between the two is your CT deduction, which you can take off the corporation, the taxable profits for corporation tax purposes.
Okay, lovely. One follow up to the question on the director: does it make any difference if they're non-exec directors?
Yes, it does. Go on, sorry.
No, it's good. We've had that question recently, actually, and there's been debate about what counts as whether non-exec qualifies as an employee. Some people think it does, some people think it doesn't. So there is some room for debate there. And what we would do is apply to HMRC for non-statutory clearance to get their view on that. But there's mixed messages in the market, is what I'd say.
Okay, thank you. And lastly, before we move on, concerning EMI, is a key part of implementation using an experienced lawyer to draft the documents, or can you get off-the-shelf documents to use?
That's a good question, Kevin, because I was aiming for that type of question. But yes, I think in having just going through this process myself on an EMI, it's fundamental that you have a good lawyer it's not good, experienced lawyer in these type of schemes, because they will know what type of documents will be required to implement the scheme, and they will know the ins and outs of the points where they really need to bottom out and agree and make sure that they are done properly. So yeah, absolutely key.
Okay, great, thanks. And going back to the EIS slides, maybe this one for Sam. I guess Raj has asked, is there a step-by-step guide for accountants to setting up an EIS or SEIS produced anywhere?
Well, Sam, I'll take that. So I'm assuming it's more a question around a company applying for EIS status.
Yeah.
Basically, it's on HMRC's website, so there is, but you actually have to start the process. So there isn't a download as such. It's one where you have to actually start the online process and then answer each question in turn, step by step.
Okay, thank you. Does an IFA company providing financial advice qualify for EMI?
No, it doesn't. Financial services are excluded, aren't they, Seth?
No, yeah, I think they're one of the excluded trades, so to speak.
Yeah.
Excellent, easily answered. Thank you very much. Please carry on.
Okay, thanks. Okay, this over to me then. So capital allowances, I'm sure this is an area that everybody listening very familiar with. It's the only form, I've tried to keep it very simple, only form of tax relief available for capital expenditure. Been around for an awfully long time. But why is it great, I guess? I think what I've seen in my sort of 22 years giving tax advice, I've seen people going from generalists to specialists essentially, and most good capital allowance specialists are dual qualified chartered surveyors and chartered tax advisors. And what I've seen from involving people like that in capital allowance analyses is at least a 20–30% uplift in any claim that goes in. And I think that's the real benefit, I guess. And why are they great? It's twofold within that bullet, that investors looking at, be it building projects or buying properties or expensive pieces of plant and machinery, need to make an investment decision, often raising loan finance, and to be able to justify that investment decision in the first place, including capital allowances in that investment decision making process is very important and can significantly reduce that upfront cost initially. But also the second point there about return on investment is increased as well by, again, modelling in the capital allowances that are available on that acquisition of that capital item. So that is why capital allowances, if done properly, are great. In terms of the tips that we see, so I'm not a deep specialist in this, but I did speak to our head of capital allowances, who is a dual qualified surveyor and chartered tax advisor. And there's a bit of a misconception that we see a lot, that capital allowances is something to be done after the year end or even when the computation's being put together, and that really couldn't be further from the truth. So really, it's about involving a capital allowances specialist at the outset, if possible. So when when the costings are being put together, when the forecasts are being built up in terms of the generation of the asset itself. So often at design stage is the point there. So when a QS would be appointed, as example, and why would we do that? Fairly obvious, but it can really influence the capital spend, like I mentioned earlier, and therefore potentially get budgets agreed with finance teams and things like that, which or with finance providers, in fact. The point around architects there is quite an interesting one, in that architects always go over budget. They get carried away. But if, for instance, you can work with an architect to actually, knock 20% off the price of a project, then that can justify their fees as well. The other point is that we find an awful lot is that at the end of projects, by the nature of the work they do, quantity surveyors and architects have all naturally moved on to the next project. So if, for instance, we're working for a property investor who's looking to make a capital allowances claim, trying to then get back in touch with advisors such as architects and QSs that he's used in the past is incredibly difficult, and they often might want to charge him or her for dragging the data back out from their files, essentially. And then in terms of second-hand properties, you may or may not have heard of what's called Section 198 elections. These have been around for a little while now. But again, there is a requirement for a vendor to what's called pool the capital allowances available in any second-hand property that's being sold. And again, using a specialist capital advisor, be it on the buy or the sell side, to get involved at an early stage with these Section 198 elections, which for all intents and purposes end up being a bit of a negotiation between both parties to establish what the buyer is acquiring from a capital allowances point of view. It's tantamount really to get somebody involved early again. And then just in terms of when is it worth using a capital allowances specialist versus just simply doing it yourself, and by that I mean just doing your own tax computations or getting somebody who is a compliance specialist to do it, we tend to see the benefit being around 100,000 of spend upwards involving somebody. That in itself would often pay for the fee of somebody doing it, if not more. So that's all I had to say on that.
Okay, so we've got a quick question here about the Section 198 election. Can you just clarify exactly what is a Section 198 election and what format does it take?
Yeah, it takes the format of a submission, I guess, to HMRC. It's the actual output is quite a simplistic sort of document, but what's behind that is more the analysis of all the assets that where capital allowances have previously been claimed, and as I've mentioned sort of earlier on when talking around this slide, it's about understanding what allowances have been claimed to date on every asset, pooling them, and then agreeing between the vendor and the acquirer the amounts that will pass over essentially in terms of capital allowances to the acquirer. Sometimes that may be nil, and sometimes it may not be. So, but yeah, the point being, again, it's absolutely tantamount to get that right in the first place, because otherwise, if it's not done properly, the buyer will lose out completely and have no capital allowances whatsoever to claim going forward.
It's probably worth assessing it. Probably worth pointing out on that, Kevin, and that question is that there is a set form, and you can't simply just clump all the assets, features and fittings together into one round column and with one number. It's got to be broken down with values attributed to each item, which is why you need a specialist involved. Having done these claims before myself, it's quite an arduous process, but rewarding, because you can get these tax reliefs that you didn't think you could get formally. So it is quite important to get someone involved. It's just before we move on, one question on the EMI that I've looked into since our call, since I finished my EMI bits, about whether IFAs can qualify. They can qualify for EMI purposes, but it's fact dependent, because something in terms of excluded activities for EMI, financial activities are excluded. So with something like an IFA, you'd have to check what they do on a case-by-case basis. But I've seen actually where it has been accepted, and I've also seen cases where it's not been accepted. So it's a case-by-case, an example of case-by-case. Sorry. So if anyone needs any more information, please do feel to contact me, Matt, or Sam on that basis. That's it. Thank you.
Thanks.
Yeah, thank you.
Quick to answer that one around EMI and IFAs, but there is generally an exclusion for financial services companies. But I agree that you need to assess these things on a case by case to see if it falls within the definition of a financial services business. So thanks for that, Seth. Okay, moving on. Over to you, Sam.
Thank you. So yes, business asset disposal relief, formerly known as entrepreneurs relief, and for those of us old enough to remember, that itself was formerly known as retirement relief take 2. Somebody in the revenue had a sense of humour, renaming it bad relief, of course, but as I'm sure you're all aware, we don't have any complicated 4 nights calculations anymore. Simply, so long as the game falls within the relevant limit, you can get the CGT on qualifying gains down to 10% rather than the current 10% or 20% rate for normal gains. Obviously, the rate for residential property and carried interest is 18 and 28%. The limit has been played with numerous times over the years. It was up to a fairly healthy 10 million, but it was decimated in 2020. Now it is just £1 million. There are, of course, qualifying criteria for business asset disposal relief, and the qualifying period was increased to 2 years, up from 1. But the main qualifying criteria are, of course, that you need to be an employee or director of the company, but there is no minimum hours requirement, so part-time employees can qualify. It needs to be your personal company, which I'll talk about in a second. And of course, it needs to be a trading company or the holding company of a trading group, which I'll talk about a little bit later on. The recent changes to the personal company qualifications, basically now you need to hold 5% of both the ordinary share capital on nominal value and the voting rights. But they've also introduced 2 other criteria, basically to stop people messing around with share rights on a company and essentially generating a position where shares would qualify for entrepreneurs relief without having the actual economic benefits of 5% in that company. So now, in addition to the 5% of share capital and voting rights, you also need to be beneficially entitled to at least 5% of distributable profits and 5% of assets on a winding up, or be entitled to 5% of the proceeds on a sale of the company's entire ordinary share capital. I'm going to talk a bit more about ordinary share capital at the bottom, but basically what we're trying to get to is a point where somebody genuinely has an entitlement to 5% of the value of that company. In a simple company with just ordinary shares, that's really easy. In more complicated companies where we've got preference rights and hurdles, it can get really quite complicated, and in some cases the answer will depend on the sale value of the company, whether somebody's going to qualify for business asset disposal relief or not. Why is it great? Well, any tax relief is of course great, but since the limit has been reduced, the maximum benefit is now £100,000, which is of course £1 million at 10%, which is the 10% that you're saving, as otherwise you'd be charged at 20%. You can, of course, get multiple limits across family members, provided they all own at least 5% for that requisite 2-year period. So you can do some planning across families, but you do need to make sure you've got a 2-year run-in time. Are its days numbered? The cynic in me suggests that they've changed the name from Entrepreneurs Relief such that when they scrap it, they can't be accused of targeting entrepreneurs. And also, over the past few years, the Revenue and various public accounts committees and select committees have been looking at capital gains tax reliefs in particular to see what they're for. And while most entrepreneurs always saw entrepreneurs relief as a reward for their hard work and investing in the country and in business and in employees, the government are actually seeing it as an incentive, and their position is that actually it's not incentivizing anybody to be an entrepreneur, because if you're going to be an entrepreneur, you're going to do it anyway. So is entrepreneurs relief actually achieving what it's there for? So, nothing concrete, but you never know. So what are the tips that we're talking about? I mentioned earlier about ordinary share capital. There were 2 big tax cases on this, which you've probably heard of a couple of years ago, McQuillan and Warshaw. These were actually the opposite way round cases. In McQuillan's case, there were 2 couples who just owned ordinary share capital, and as part of a transaction, one couple had their loan converted into equity in the company as a condition of a lending exercise, and that meant that the other 2 shareholders' holding was diluted down to less than the 5%, so they lost their entrepreneurs relief. Warshaw was the other way round, where there were shares with a coupon, and the definition of ordinary share capital includes things with other than an entitlement to fixed capital. So because this coupon had interest, it was argued that they were included and he would get entrepreneurs relief at the time. Since McQuillan, they've introduced a new thing called a dilution election. This is one of the elections we can consider when we're looking at business asset disposal relief. And basically, if there's some kind of transaction whereby your shareholding will be diluted under that 5% as a result of an issue of shares, which could happen in a number of ways, similar to MIQUIL, and it could be in terms of refinancing a loan, or it could be some external investment, perhaps by private equity. You can make what's called a dilution election, and in case you're interested, the clauses for this are in section 169 SB to SH of TCGA, because clearly it wasn't complicated enough to have section 169 up to SA. And in that election, you can essentially bank your business asset disposal relief at the point it gets diluted, but handily, to avoid generating a dry tax charge such that you're generating this gain to get business asset disposal relief, but you've got no cash to pay it because you still own your shares in the company. You can also make a deferral election to defer the payment of that tax until you do dispose of the shares. So anytime when you're looking at somebody's shareholding being diluted, look at that and think about it. They are irrevocable, but it is worth considering. The other one, of course, is a section 169Q election, where you're exchanging shares in a company for perhaps loan notes if somebody's buying it out or something, because the loan notes by themselves won't qualify. So if you would not qualify on a future disposal, then the idea is to crystallise your business asset disposal relief now and pay the tax, but you're getting it at 10% rather than the 20%. The final point I wanted to talk about was a definition of a trading company. For capital gains tax purposes, it's activities that are not to a substantial extent not trading. And in broad terms, we consider this to be the 80-20 test. So long as it's 80% trading, you can do 20% of non-trading activities. The Potter case, though, was an interesting example from a couple of years ago. In that case, company wasn't doing very well, and what was left of the assets, the majority of those assets had been invested in long-term bonds that did generate a return, and that clearly is an investment activity. But the case actually found that while a lot of the money had been put in these investments, the owner of the company was going out trying to drum up business and was actually acting as if he were trading. The fact that the company didn't do anything and they didn't really restart the trade was kind of irrelevant at the point the case decided that that did constitute a trading company. So even where there are investments, all is not lost. You do need to look at it again, as we said, on a case-by-case basis.
Okay, thanks, Sam. We've got a quick question concerning business asset disposal relief. If the client gives his spouse some shares in the company before they sell, will they get the business asset disposal relief as well?
It depends. If the spouse has owned 5%, meeting those criteria that I spoke about earlier, for 2 years, then you could give your spouse additional shares shortly before a sale under the nil gain, nil loss, and you'll both get business asset disposal relief. But if you just make a transfer beforehand, the 2-year holding period won't be met, so you'd need to hold them for 2 years beforehand.
Okay, great, thanks.
Okay, Matt?
Thanks, Matt. So I'm going to talk about tax dispute and resolution. So this in itself is a very specialist area, which is relevant in today's environment, given how litigious HMRC can be. And actually, the key point being here is how much access HMRC have to information about your clients, and it's constantly increasing. Things that they've got their hands on, fingertips on immediately is things like social media, government departments such as DVLA, Land Registry, Companies House. Obviously got the HMRC own portal. They've even got tax evasion and fraud hotlines. So these things are increasing, and the amount of information they can get hold of is quite increasing as well, and it's easy for them to make a case and basically open an inquiry. So, in terms of what is it, it's any form of tax dispute really, where you've got HMRC on the other side, where you're looking to make voluntary disclosures to HMRC, and we also see things like expert witness work with HMRC in dispute work. I've already talked about the want access to client information. That's got to be key, and I suppose that's only going to increase as HMRC are increasingly getting their hands on more and more information and requirements to comply with certain things. Even like trust, for example, you're registering trusts with HMRC. access to that information. So it's increasing, and it will always, they'll always have more information available to them. So I suppose it's a slight quirk on the words. Well, why is it not so great? It's because it provides HMRC an opportunity to try and widen the scope of their investigation and ask far-reaching questions. And the temptation is always to answer the question, because you think, oh, you've received that brown envelope through the door and think it's not gone to dreaded HMRC. They're asking the question, so it should be compliant to manage any issues with them and any potential penalties, etc. And nobody wants that, and he always leaves you with a cold exterior or interior feeling. So it's not great. So the key tip I would say here is consult with an expert on this matter. These experts are used to dealing with HMRC. They can take the emotion out of the process, and they can really give good strategic advice in terms of how much you should disclose to HMRC, because HMRC do have a tendency to ask questions which are not allowed to ask, because I know in most cases people will give the information. So having a specialist alongside you will kind of manage that process and have a strategy of how you should approach HMRC. And having spoken to our tax disputes expert, she has a number of contacts HMRC inspectors who are kind of work in this field, so she can pick up the phone to them, email them, and get direct access to them, get their view on things, because they've developed that relationship over the course of time, as opposed to going through a generic submit your disclosure to a generic email to HMRC. You can get direct access to these specialists at HMRC. So the key message from me here is really to get someone who is experienced in this area and can help you develop a strategy. And HMRC will only, I'm sure, they'll only ask for more information if they can get away with it. But if they know you've got specialists alongside you that will push back, then it can be no bad thing. So that's it for me, Matt, on that respect.
That's great. Thanks, Seth. Okay, so research and development, certainly something that I'm sure everybody's heard of before, something close to my heart. The legislation was introduced the year I started my career, so it's been around quite some time, and I've been doing R&D claims personally since the legislation came in. So I've seen it evolve, and I've seen an industry grow around it as well. But what is it, I guess? For those who don't know, it's an enhanced tax relief for every pound that you spend on staff, subcontractors, software, consumables and utilities on what's called qualifying R&D expenditure. You get additional tax relief, and that can take the form of cash back into the company. It could take the form of increasing tax losses to offset against future profit, or just simply reducing the future tax liability, corporation tax liability for a business. But why is it great? Well, I think the figures there speak for themselves, in terms of the tax savings available. Obviously, a lot less generous for large companies, which is the RDEC, but nonetheless, the large companies like a GlaxoSmithKline or a Shire Pharmaceuticals, I'm sure they still don't mind getting that type of tax relief for expenditure they make. But yeah, and also in terms of an investment decision-making process, I see this an awful lot now, where businesses are assessing whether to develop a new product or a new process, or indeed buying a piece of equipment that will enhance pre-existing R&D process, and they are factoring in, and they get us to help them with this, the likely R&D tax relief available in terms of the staff and subcontractors and so on and so forth that will be working on that process for them, and whether it's worth making that investment decision. So it does form a big part of that process these days, because the tax relief is so generous. Now, in terms of tips, I could probably have written a page on this, because we see an awful lot of the good, the bad, and the very ugly when it comes to R&D. But in terms of the timing, first of all, so there's two parts to an R&D claim, which again I expect a lot of you know, so forgive me for this, but the first being what's called the technical narrative, so actually identifying the projects that might qualify, speaking to what's called the competent professional in the business to understand those projects, and then writing them up, and that forming part of the report that goes into HMRC. The second part is pulling together the financial data that justifies the costs that were attributable to that qualifying project. In terms of the first part, the timing of the technical narrative, again, not dissimilar to capital allowances, but there is a bit of a thought process around leaving this to the last minute, only doing it when the corporation tax return is being put together. But that really shouldn't be the case. We are often speaking to competent professionals and business owners in year, so in financial year. So as projects are completed, we've got clients keeping notes, we're speaking to them as they go along, just to ensure they're capturing everything they can. But I'd probably say more often than not, we tend to run our tech narrative calls just after the financial period. And the main reason for doing that is that it's fresh in their minds, that they've got good recollection of what they did over the last 12 months, and much better than they would have if it was 24 months later. Often the data is better in terms of actually them digging out the data that we need, and the sort of project notes and so on and so forth, and potentially contracts. And also it mitigates to some extent the potential for key personnel who we need the information from having left the business. So those are probably the key parts in terms of timing. Overkill is another point here. So what we see a lot, and what we've changed in our business, is that the claim and the narrative needs to justify the size of the claim, if that makes sense. So, and it needs to be a sample, it's a flavour for HMRC to understand that there is qualifying activity going on. So just because a company may have 20 projects in a year that would all qualify, that doesn't mean that all 20 projects have to be written up and submitted. So it could just be a couple of projects with some narrative saying these are a sample of qualifying projects. Further details can be provided. And that delivers efficiencies from our side and economies of scale. Whereas a much bigger claim would probably justify and warrant actually including more projects to obviously justify the size of the claim itself. So the reverse is true too. Buyer beware, the third point here. So I don't know if any of you got the opportunity or have even bothered to read this particular piece of case law, Haddy Engineering, but my takeaway from this was I actually felt very sorry here for the business owner who actually ultimately had to represent himself in court against the HMRC, because the provider, the R&D boutique in this case, despite having an engagement in place that should have meant that they supported him up to the first tier tribunal, decided to wash their hands of the guy. And so the revenue did what they're good at and essentially tore his testimony apart, and also his R&D claim, which must have been an excruciating experience for him. But some of the takeaways from this were, in particular, ensuring that there are good and detailed contracts in place with customers, so that there is a clear understanding of who is doing the R&D and where the intellectual property sits, i.e. does it sit in this case with Haddy Engineering, or does it sit in fact with the customer who's commissioning Haddy Engineering in this case to undertake certain projects. That's absolutely critical, something we look at quite a lot. And there were various other things that came out of this, which again I could write an essay on. But what we are seeing in practice post this case being delivered is that HMRC, some of the we don't see a lot of inquiries, but some that we do see, HMRC are starting to overreach and use this case as one basically to justify the reason for their inquiry, and essentially in some cases refuse claims on the basis that a business, most businesses that we deal with undertake their R&D as a result of a customer requesting something new. So therefore the business has to go away and have a think and actually undertake R&D to deliver the commission or deliver the project that's been requested. And the overreaching point that we're seeing is HMRC is saying, well, essentially it was just part of the contract with the customer that you had to do R&D, which can absolutely not be the case, because more often than not, a new project will require a new process, a new technology from our customers or our clients' behalf. So, and we have gone back quite firmly with HMRC and saying that they are overreaching it and got favourable outcomes for our clients. So that's just be aware of that if you are seeing these. And then the final point is around protecting IP and patent box. Really, just every time now we are speaking with businesses about R&D, we're also having a conversation to ask, how are you protecting your IP? Are you going to file for a patent? And then the subsequent conversation being around potentially claiming for revenues generated under the patent box regime. So again, that's just a heads up on that point. Any questions, Kevin, or shall I move on? I'll move on. And then back to you, Sam.
Yeah, so business property relief. This is the IHT relief. I mean, it was always traditionally called business property relief. The revenue often referred to it just as business relief, which I think just gets complicated. But it is a valuable relief that applies to business assets. It applies to assets used in a business, as well as business interest and shares in qualifying companies. But it is worth noting that if you have an asset that's outside of a company, for example, but used in a business, you're only going to get 50% relief on that, whereas assets within a person or company that qualifies will get 100%. Qualifying companies need to be unquoted, but AIM companies do still count as unquoted, and sometimes the use of AIM portfolios is used to try and mitigate BPR risk, particularly if you've only got 2 years until an impending death. Because BPR applies on both lifetime and death, so transfers of business assets during your lifetime as well as assets held on death. As I've said, relief is available at 100 or 50%, and 100% relief is, very generous. The reasoning behind it being that if you have a small family company and the founder dies, his heirs aren't necessarily going to have the money to pay an IHT liability. So it enables, companies to continue on without needing to stop and fund a tax liability, which could very well see the end of the company. What this does mean is we can get a potential double relief on business assets on death. If you've got a business owner who owns 100% of the shares in an unquoted trading company and he dies, if the following generation would want to sell it, if he dies, he's going to get 100% business property relief. But if he dies owning those shares, he's also going to currently get the CGT uplift to market value on date of death. So he could potentially then, or his executors or his family could sell the business after his death. They wouldn't have paid any inheritance tax on inheriting it, and they would pay very little or nothing CGT on the sale. It is a point to note, though, when using probate value, HMRC will only be bound by probate value if there's been inheritance tax assessment made on those sums. Otherwise, they do reserve the right to actually go back and revise probate value if they think that you've put it down slightly incorrectly in order to benefit from these reliefs. It is also worth noticing that the trading company definition for IHT is wholly or mainly, which through case law has been to be 51% test rather than an 80% test, as we were talking for CGT. Of course, what is a trading company? There are lots of different things. The one particular to watch out is furnished holiday lettings business. Although they qualify as businesses for various taxes, they're not going to qualify for business property relief purposes. There is a stream of case law. It's very, very rare that any kind of letting business that's not a hotel is going to benefit from business property relief. The most famous case of recent years that did get through, which surprised most people, and it was also upheld by the upper tribunal, was the Veen case, which was a horse livery stables, and that was given as business property relief, where furnished holiday lettings that were providing lots of services to clients didn't, when essentially these people were sticking a horse in a field and giving it some oats. The difference was considered that the owners of the livery said it was more akin to a children's nursery than to a furnished holiday lettings, although I know some children are terrors. Most of them don't get put in a field and given a nose back for the day. Anyway, what are our tips for business property relief? Pre-sale planning is the big one. We see a lot of clients who are, in the process of selling a business, perhaps getting private equity involved, and they're basically converting an asset, their company that they've grown up to be quite valuable. They're changing that asset that's getting 100% IHT relief into cash, which of course is going to be fully chargeable to IHT. So if you're selling your business for £5 million, you're giving yourself a £2 million inheritance tax problem. So provided we can get some shares out of someone's estate, for example, into trust before a sale goes through, then potentially you can get those assets into trust, benefit from 100% BPR, and then the sale proceeds are realised in a trust, and you've got more value in that trust than you could have done otherwise, because otherwise you'd be limited to your nil rate band, which is currently 325,000 per person. You do need to watch the binding contract for sale. Theoretically, that means that right up until you sign the contract, you could transfer those shares into trust, but we think it's better to have a bit of a gap between the two to ensure that there is separation between the two transactions. Other BPR tips are to do with holding companies, where you have a holding company, provided it is its main business, again on this 51% test, is of being a holding company, you can essentially look through and look at the group as a whole to see whether it's trading or not. And this means you can actually get holding companies with quite significant levels of investment in them to qualify for 100% BPR. I recently had a company that had over £17 million worth of investments, and it was still all given as 100% BPR. And part of doing this is the non-statutory clearance process, where you've got to transfer into trust. There is a process by means you can apply to the revenue and ask them to confirm whether BPR will apply in full. Now, it's beyond a lifetime transfer, it has to be chargeable. So gifts to individuals won't count because those are potentially exempt transfers. But a gift into trust will count, but it has to be over the 325,000 or they're not going to respond. I've even seen cases where the value was around that level and they've basically said it's not worth their while replying because the tax at stake isn't large. There is a prescribed format on the Revenue's website that tells you the details to include, but obviously you need to tell the Revenue the story in the right way to make sure that they understand that this is all a very good trading company, and they don't have the 28 days to apply as for a statutory clearance, but normally they turn things around relatively quickly. And if you've got that, you've normally got 6 months from the date of that clearance to make your transfer, and you know that you've got this 100% BPR ruling from the Revenue. So those are our tips on business property relief, and I'll hand you back to Matt, I think.
I think we're at risk of running over, but we'll just keep going unless Kevin tells us otherwise. So back to you, Seth.
Thank you. Given the time, I will keep this short and sweet because I'm sure everyone is aware of the job retention scheme that was introduced as a part of a wider package to help businesses through the lockdown period. The kind of 3 or 4 bullet points, what is it, sum it up quite well. But the key thing I want to highlight there, as I'm looking at the government information on this, is that 1.3 million employees benefit from the scheme, so that's a huge number. You can imagine how many employees each employer has on their books, and they've claimed for each of those people. That's a big number. And why is it great? It obviously saved a lot of jobs, and it was really good just to get through that tough period of time. But what was it bad? And our tips, I suppose, it was rushed in, it was clunky, and there was various mistakes that were made by HMRC on the system that they introduced to make the claim. The rules weren't very clear, so by default there are a number of mistakes being made. And if I just summarize, in terms of how many iterations of the rules there were 7 iterations of the rule, and each of those rules are changed slightly. So you can imagine that if you're not into the detail of each iteration, it's easy to make a mistake. HMRC are very much aware of this, and we've seen this many times in pre-sale due diligence, where we have been asked to review furlough claims, and I would say probably 9 out of 10 claims are incorrect because people have not understood the iterations of the rules. They've still claimed in the previous iteration of the rules, and they continue to do so. There's been fraud. We've seen people. We've got a live case, I think, where a director has asked his employees to work during furlough, and still claimed under the job retention scheme. And so HMRC are very much aware of there are mistakes, and they're also very much aware there's a lot of fraud that's been undertaken by various people. So, which is why HMRC have said and publicly announced that they're going to focus their efforts on these schemes and looking at and reviewing and looking at the schemes and the claims made. So they've announced they'll be reviewing claims on a regular basis, and they have 6 years to do so. So every time we do a sale process, we always include a tax indemnity for furlough tax indemnities to ensure that the seller, so the buyer, is protected from any claims, given that they've got 6 years. They must have 6 years to review claims. So they've also introduced a process. HMRC, they as an HMRC have said, we would say to review the claims. If you want to make a voluntary disclosure because you have found mistakes, then there is a process where you can approach HMRC and make a voluntary disclosure and make good on the tax that you've collected, the monies that you've claimed. There also are cases where you've not claimed enough, so that's also there can be an upside there. But yes, it's in these type of complicated situations, and given that there are various 7 iterations of the rules, it's best to get someone involved to help you review that process and the claims, because as you can imagine, there's many employees just in one company, never mind 1.3 employers benefiting from this initiative. So that's it for me, Matt. I'll keep it short and sweet given time, so I hope that's enough minutes.
Okay, I think this is the final slide. Sam?
Yeah, and I will be quick. Investors relief, the poor relation of capital gains tax relief, simply because everybody just forgets it even exists. It's kind of like a mix between business asset disposal relief and EIS, because it works in the same way. The gains are charged at 10%, but it implies to investors in a business, and the conditions are very similar to those for EIS. You're not supposed to work for the business and things like that. There's no minimum thing, but the great thing about investors relief is that you've still got the £10 million limit retained. It was brought in at the same time that was a limit for business asset disposal relief, but that limit has not been reduced. So you can still save up to £1 million worth of tax for shares subscribed for after 2016. So you mustn't, or your connections mustn't be an officer or an employee of the company, but it's worth considering where EIS or SCIS relief isn't available, because remember, of course, as long as we hold those shares for 3 years, the gain's exempt. In this case, because we've got a £10 million limit, unless we're talking very big investment sums, you can broadly achieve the same result. But the key point to note is there's no minimum or maximum shareholding with this. So you can own more than 30%, which you can't do for EIS. But going back to the excluded trades points we spoke about earlier with the IFA, so long as it's a trading company and it meets the rules for investors relief on that thing, there aren't, so excluded trades for EIS may still qualify for the investors relief from capital gains tax. So there you go, save yourself £1 million in tax, and I don't know.
Thanks, Sam. Fabulous. Okay, obviously we've been taking questions throughout the presentation. We're 7 minutes over, so we almost did it on time. But Helen, have you got any more questions for us?
That's fine. No, I think we've asked all the questions that we've had. If anybody has any questions afterwards and they want to send them in, please feel free, and we can pass those on.
Yeah.
Meanwhile, can I thank you all, Matt, Sez, and Sam, for presenting today's webinar. We covered quite a lot of ground there. And I'm sure everyone really appreciated the time and the breadth of the coverage you gave. Thank you all for listening in as well. This is one of our monthly webinars. We have another one next month. I think it's on national minimum wage, and we hope to see and speak to as many of you as possible then. So can I leave it to you, the 3 of you, to say your goodbyes and speak to you soon.
Thanks, everybody. Appreciate your time.
Thank you all. Thank you. Appreciate the time as well.
Thanks. Bye.
Excellent. Thanks all. Bye-bye.